Accounting makes economic activity, such as transactional exchanges, as well as economic relationships evident in debit and credit arrangements, visible. An analysis of balance sheets makes clear the unique, expansive quality of credit. Much of this presentation derives from Perry Merling's Money View course, which is linked to in your optional reading. All banking is essentially a swap of IOUs, and the analytic accounting apparatus tracks how these swaps manifest as stocks and flows. In this segment, we'll be looking at both solvency and liquidity, the former through balance sheets noting stocks of assets and liabilities at a given point in time, and the latter through expenditure and income statements, which track sources of flows. We'll see that there are natural tendencies, meaning deep behavioral features, of an exchange system that has both monetary and creditary components, and these tendencies manifest regardless of the particular institutional details. Banks are linked to other banks through their balance sheets, where assets at one bank may be liabilities at another. Time matters when it comes to the flow nature of this system, which we'll look at through understanding the evolution of the banking payment system. But we'll build up to all that, and let's start without banks and with a simple exchange of a good for cash, M, with two actors, me and you, where you sell me a good valued at M. The balance sheet record of this transaction, where you have me on one side, you on the other, and then A and L stand for assets and liabilities. So on the asset side, I gain a good, you give up a good, I lose some money, and you gain that money. The same amount of money is in the system after the transaction as before the transaction. Notice the plus and minus entries cancel each other out. The quantity of money doesn't change, it just moves from my control to your control. The same exchange could be made through IOUs instead of me spending my cash. Here, I have a good, you give me your good. Now I have a liability, which is an IOU, and you gain that as an asset. Given that between us we have M in cash, money in the system has now expanded by M. IOUs increase money and the system has more money, though of a different form, IOU instead of cash. Let's leave aside for the moment the question as to whether cash is an IOU as well. Notice the 2 plus transactions which expand the balance sheet. Remember that IOUs themselves can have purchasing power. Say someone else, we'll call him, accepts my IOU from you in exchange for goods. So again, you gain a good, he loses a good. You lose the IOU as an asset, and he gains the IOU as an asset. We have the same situation as the first cash-based example with IOU standing in for M, with a plus and a minus transaction, and the quantity of money is the same before and after the exchange. See the moneyness of the IOU? Credit relationships require trust, and parties entering such relationships run risks of debtors defaulting. I could decide not to pay him when he presents the IOU for settlement. Banks can act as intermediaries in these situations where multilateral credit relationships are undesirable. Again, let's say I buy a good from you for M, but this time introducing a bank to manage the credit transaction. So we have me, bank, and you, assets, liabilities. So I gain a good, you give up a good. I now incur an IOU, which is an asset for the bank. It's a liability for me, it's an asset for the bank. Now the bank loses some of its asset money, which you then gain. The money in the system expands in the form of the added IOUs, payable for M at a later time. Here, the bank serves as a trusted intermediary of the original bilateral IOU exchange. But banks hold customer deposits, so the same transaction more likely looks like an exchange of goods, except here, I lose some of my assets in my deposit, but the bank loses the liability in the deposit from me. The bank gains liabilities in their deposits for you, and you gain deposits as your assets. Deposits are assumed to be claims on the existing stores of currency, though in practice, these leak into credit as well, as deposit amounts most always exceed the bank's cash reserves. Still, in this transaction, money from my deposit account is transferred to your deposit account, and the money in the system does not increase. The positive and negative entries all cancel. Thus, we see that the same transaction can be conducted in a way that either keeps the money supply constant or expands the supply. Credit transactions are thus qualitatively different from cash transactions in that they increase money and the exchange carries forward a lingering debt obligation. While credit isn't functionally infinite, you have a limit to how much credit you would extend to me, and banks have limits as to how much credit they extend to depositors. It does provide elasticity in the exchange system, allowing exchanges to occur that otherwise might not happen. To see this, let's suppose a creditless system with fixed currency. The possible transactions between you and me are limited. If M is fixed, then it's most likely that I have more than you or you have more than me, but you and me together can't have more than amplitude M. These relative quantities change over many exchanges conducted over time. So consider time to be traveling along the x-axis. Anything above the line is my balance. Anything below the line is your balance. M is the maximum amplitude, so the extent of the transactions are limited by M, and our relative balances change over time, depending on who has what portion of that M. Now let's say both you and me extend each other credit, and we see the limit for the possible transactions depends on the respective credit limits. So again, there's a transaction back and forth, bounded at the top by my credit to you, and bounded at the bottom by your credit to me. Above the line, you owe me, and below the line, I owe you. So the extent of the transaction is limited by the credit allowances. Now the largest transaction could be greater than M, regardless of who holds the money M. If the bank extends us both credit, the picture looks the same, except it's the bank's limits for you and me that determine the possible extent of transactions. These plots show cash flows over time between various parties. Hyman Minsky, who we met in our brief history, described cash flow requirements as the survival constraint, such that at any point in time, cash flow in minus cash commitments must be greater than or equal to 0. Thus far, we've been looking at balance sheets showing the values of assets and liabilities at fixed points in time, such as before and after a transaction. To understand flows in accounting, we use income and expenditure accounts, sometimes known as use and source tables. Here is some common nomenclature for such accounts. We have categories, uses, and sources. For the category goods and services, use is expenditures, and the source is receipts. For financial assets, use is accumulation, and source is decumulation. For financial debts, use is repayment, and source is borrowing. And for cash money, use is hoarding, the source is dishoarding. Again, we'll be considering bank deposits the equivalent of cash money, though they are not strictly the same thing. For each agent, every use has a corresponding source, and each agent's use is some other agent's source. Suppose I buy a book from Blackwell's. for $20. On a balance sheet, this transaction looks just like case number 1, where you and I exchanged the book for money, or a good for money. Here's how we'd notate that same transaction using the nomenclature above in an income expenditure table. I have an expenditure of $20, which for you, as a source, is a receipt of $20. I am dishoarding $20, and you, or Blackwell's, is hoarding $20. Now suppose the same transaction is conducted with a credit card. We're going to now be explicit about the temporal nature of the transaction. So we have me, Blackwell's, and Visa. And now specifically, I'm going to look at what happens at time equals 1, which is when I purchase a book. So I have an expenditure, which I make by borrowing from Visa. You have an accumulation of a credit from Visa, the source of which is a receipt. Visa accumulates debt from me, and the source is actually borrowing from Blackwell's. In this apparatus, we say I borrow from Visa and Visa borrows from Blackwell, in that it incurs a liability to Blackwell's in the short term. If we are looking at stocks through a balance sheet, we see that the money in the system has expanded through the double credit arrangements, much like the bank scenario with IOUs. At the end of the day, or T equals 2, Visa settles with Blackwell's. So Blackwell gains money, so that's hoarding. It decumulates because it loses the asset that it had from Visa. Visa settles its borrowing from Blackwell's by repayment and does dishoarding to pay back Blackwell's. At the end of the month, T equals 3, I settle with Visa. So I repay my borrowing and I dishoard, which goes to hoarding for Visa, which is a cash transfer, and Visa does decumulation, which is giving up the loan asset it had to me. The credit created in the system for the book sale is now resolved. In order for this to happen, both me and Visa need to have the available deposit funds at the appropriate time in order to dishoard. This availability is known as liquidity. Think flow. Here's where the survival strength comes into play. Let's look at cash flow over 4 time periods, T, T plus 1, T plus 2, T plus 3. Suppose I have the following liquidity structure. So in terms of cash flow, cash commitment, at T, I have 10 in, 5 out. At T plus 1, 10 in, 5 out. And the same for the other 2 time steps. So cash flow in total is 40, cash flow out or commitments is 20. So I have both liquidity at each time step and I am overall solvent. Let's look at something else. Cash flow, cash commitment. Now at T1, I have 10 in but 20 out. And then I have 10 in the next 3 time periods and 0 going out. So I see that I have a problem at time T. I cannot meet the survival constraint, even though in total over the 4 time periods, I have a cash flow of 4 and a cash commitment of 20, which means I'm still solvent, I just don't have liquidity. One more example. Cash flow, cash commitment. Now at time T, I have 5 in, 0 out. T plus 1, 5 in, 10 out. So far, so good. But at time T plus 2, I have 5 in, but 10 out. And then I have 25 in and 0 out, and I have a problem at time T plus 1, or T plus 2. So again, even though I'm solvent, I have a survival constraint problem at time T plus 2. So we see that time structures matter. And then next we'll see that a good deal of banking involves matching payment commitments to flows.